Well, thank you for having me here. I look forward to the conversation. So before we begin talking about tokenization or blockchain technology, and it's so kind of Daryl to make some comments on it, I'd like to start with a much more fundamental question. Why has this topic become so important over the last few years? Financial markets rarely adopt new technology simply because it is new or different. They rarely spend time or money on a solution that has not played itself out in the marketplace with any certainty. So, what is it that's causing financial markets to want to take a look at this technology and to actually give it time and attention? And I would say over the past 15 years or so, the demands placed on financial markets have changed significantly. Following the global financial crisis, regulatory reforms such as Basel III increased capital requirements and liquidity requirements. More derivatives are cleared centrally. Uncleared margin rules require firms to exchange collateral across a much broader range of transactions. More recently, higher interest rates have made high quality collateral economically valuable once again. And so at the same time, private markets, I think, continue to grow, and institutional participation in digital assets has increased over time. So global investors, global traders, global hedgers are all increasingly expecting markets to operate well beyond the traditional business hours. And all of these trends have one thing in common. They have increased the demand for liquidity and financing. And that in turn means that they increase the demand for collateral. What's interesting, however, is that the world's not running out of collateral. As Daryl mentioned in his portion, there's 300 trillion of assets just in the US. Most of those are high quality liquid assets. When you add that up, there's about 300 trillion of high quality liquid assets around the globe. Government bonds, different treasury instruments, and the like. Yet industry studies will consistently estimate that only around 10% of those assets are actively mobilized to support financing and liquidity. So the challenge isn't a shortage of assets. The challenge is in how those assets can move efficiently to meet the market demand. And many of the existing infrastructure in banks and broker dealers and financial market entities, CCPs and CSDs, is just not sort of up for that challenge at this moment in time. In fact, today's market infrastructure has evolved, over many decades. Securities settle according to local market hours or regional hours. Payment systems have operating windows. Different countries operate obviously in different time zones. Custodians and central security depositories operate on different operational processes and legal frameworks. And so none of these individual systems are broken. In fact, they arguably work extremely well to some degree, but collectively across the globe, they create friction. Assets can often not move when they're needed. Firms, therefore, often compensate holding excess collateral by pre-positioning securities around the globe before markets open, maintaining ledger and liquidity buffers that they would ideally like to have and be using in other more effective revenue generating activities. And so the collateral gets fragmented across multiple custodians, multiple jurisdictions, multiple time zones. Another challenge is I would say, visibility. Even the world's largest financial institutions often do not have a complete real-time picture of where all their collateral resides across legal entities, where all of their assets reside in a usable form. Custodians and markets have assets and collateral sort of spread out in different jurisdictions, and a considerable amount of effort is still spent simply trying to determine what assets are available and where they can be used. And so this is where tokenization begins to matter. I think it's important to think about tokenization the right way. Tokenization is not simply the process of creating a digital version of an existing security. Daryl talked about this. It's really important for it to be the actual asset, not a derivative of the asset, not a digital twin of the asset, not trust certificate of the asset. It has to be the asset that's actually represented on chain. We refer to it as creating an authoritative digital representation or a digital record of an asset that can participate in an entirely new operating model in financial markets. And it makes it easier to identify those assets, makes it easier to mobilize them, makes it easier to finance them, easier to use them across multiple jurisdictions. So I think creating a digital asset via tokenization doesn't automatically create economic value. The value comes from what that asset can do after it has been tokenized. And that brings us naturally to the next question on my next slide, which is, um, if tokenization is not the tokenization is not the end goal, then what is? Okay. Um, I sometimes describe tokenization as solving the representation problem, the representation of the asset. It transforms a financial asset from a traditional record into a digitally represented programmable asset. And that's an important innovation for sure. But it does not by itself transform the financial markets. And let me explain what I mean by that. Imagine taking a paper document and converting it into a PDF. Then that document has, by definition, become digital. But the underlying business processes has not fundamentally changed in any way. A real transformation, I would submit respectfully, occurs when that document becomes part of an entirely new digital workflow. And I believe that same principle, as we're discussing here today with this wonderful audience and group of minds around the globe, is I believe that same principle applies to financial assets. If a tokenized government bond sitting quietly in a digital wallet and doing nothing in the secondary markets. I mean, that's certainly interesting, but a tokenized government bond that can immediately support a repo transaction, as we have done over the course of the past year, to satisfy margin requirements, to move between financial applications, to settle automatically with digital cash, and be used and reused later again that same day. Well, that's transformational. That's the value that's not created by tokenization alone. It's created by the economic activity that tokenization enables. And the distinction, I think, is critically important because discussions about digital assets often focused almost entirely, at least up until the last year or so, on issuance, when in reality, issuance is really just the first step. Secondary markets, as I've sort of alluded to in my comments so far, is where financial markets really create most of their value. Trading, financing, securities lending, collateral management, and asset servicing, treasury management, payments, liquidity management. These are the activities that determine how productive an asset becomes throughout its lifetime. And so one observation I've made over the last several years, but increasingly more in the last couple of years as we've worked with DTCC and others around the globe, is that financial markets have spent the past 50 or so years optimizing transactions. We've built arguably remarkable systems for trading, matching, confirm, settling transactions. In separate duplicative silos around the globe. So I would submit that the next decade will be about optimizing those assets themselves. Historically, assets have been relatively passive in the process of workflow. They sit safely in custody. They occasionally move. They generate income. But by and large, they're static records. I think what's different is that digital assets are not static records. To the point of your introduction, they become programmable economic objects. They can finance, they can satisfy margin, they can support securities lending, they can move globally on a moment's notice, they can interact with multiple independent financial applications. They become, as assets and as instruments themselves, significantly more productive, and they enable that productivity. They are enabling that productivity by requiring tokenization, and moving beyond that, it requires the networks that support that. So if I could for just a minute, networks allow these independent applications to communicate with one another while each institution continues to operate under its own governance, its own regulatory framework, its own commercial model. Interoperability, therefore, becomes critically important. Otherwise, we're still just we're creating a new world of these separate duplicative operating silos. So I would note that interoperability is frequently misunderstood, or it's usually focused on as being a network to network matter. It's not simply by moving tokens from one blockchain to another. Rather, it's about enabling independent financial applications, and an application from DTCC in the US or JSCC in Japan or the TMX in Canada or Euroclear and Clearstream in the UK and the EU, enabling independent financial applications to coordinate complex multi-party workflows while each continues to maintain its own business rules, its own jurisdictional, regulatory, and legal governance, and its own privacy requirements. I will say that what ultimately emerges is not just simply a collection of tokenized assets. What emerges is a digital financial network, I would submit, where trading, settlement collateral, where risk management and asset servicing remain synchronized in real time, where markets become connected workflows rather than disconnected processes. And that naturally will lead to where you would go next. If we're building this type of financial infrastructure, what characteristics must that infrastructure provide in order for institutions to be able to trust it? So what matters in a ledger for financial markets, and I am going to lean a little bit on the ledger that I know here, which is Canton, but I would submit to you that the comments that I make are not solely about that one blockchain, but would apply to any of the digital networks that will undoubtedly become successful around the globe. What I would say is that financial markets are among, we all know this, financial markets are among the most regulated and risk sensitive or risk aware industries in the world. As a result, the characteristics required of financial infrastructure are very different from those required for consumer applications or even public payment systems to some degree. I would highlight four characteristics that I believe are essential, and it's a little bit misleading because there's three on the page, but let me go with the fourth and I'll tie it together. So the first is mobility. Assets must move efficiently across institutions, across jurisdictions and applications while preserving the legal certainty and operational resilience of the entities that are party to a transaction with those assets. If those digital assets cannot move more effectively than traditional assets, then we've not solved anything in the form of an underlying problem. We've, been the proverbial hammer searching for a nail and created a solution for a problem that didn't exist. So the second one is where it becomes critically important when thinking about a digital ecosystem, which is privacy. Privacy and transparency are not the opposites. I actually often find this curious when I talk to a crypto audience that tends to assume that transparency is the ultimate and privacy is what you should try to avoid or is a negative or a risk. But regulators require transparency. Market participants require transparency or confidentiality of their terms. Good financial infrastructure supports both it supports both simultaneously by ensuring each participant can only see the information necessary for its role, while, say, a regulator or a supervisory authority or an auditor retains the right to have appropriate oversight. So privacy is key, is essential. I might actually submit to you that privacy is what enables trust in financial markets because it allows for the certainty of knowing that only those entitled to know the terms and conditions of a transaction are in fact those that actually have it. And the third is sovereignty. I think this is or aligned incentives, and I think this is an increasingly important concept as many of the market participants around the globe in this space begin to move from POCs and pilots into actual live production transactions. I think it's an increasingly important topic. Financial institutions, for the most part, do not want to surrender their governance models or their compliance frameworks or their client relationships simply to participate in a network. Every application should retain its own governance or commercial model, should retain its regulatory responsibilities while still interoperating with other applications. And that allows for innovation without forcing every institution into a single operating model. Financial incentives matter. Sustainable financial networks should reward participants for creating genuine economic activity. Builders should be rewarded for developing applications. Network growth should reflect real usage rather than speculation rather than speculation or rather than being driven by social media activity. It should be based in real economic activity that's moving across a new financial ecosystem. So when these characteristics, mobility, privacy, sovereignty, and aligned incentives, so those four that you see represented as three on the page, come together, we begin creating infrastructure that's appropriate for institutional financial markets, for systemically important, highly regulated institutional financial markets. The technology, frankly, and I realize I represent the technology firm, but the technology becomes invisible. It matters instead what markets become as more efficient, more connected, and more productive, and that infrastructure exists, or once that infrastructure exists, we can turn to debating the economic value of different transactions and how tokenization and some of the applications in their new forms of products and services can enable more growth. And so what I would say is what we should be thinking about next is what does the future of that financial market actually look like? And so here's a bit of a discussion that we could have. If we were to build this type of infrastructure, what does success actually look like? Well, if we accept that tokenization creates a digital representation of an asset and then interoperable networks enable assets to move and interact, then the next question becomes, what are we actually trying to build? And in my view, the objective is not simply it's not simply about a more efficient settlement system. The objective has to be a more connected financial system. I think that success can be described in the three primary goals you see on the page. The first is unlocking assets that candidly already exist, but unlocking them to have more power and more purpose around the globe. We often speak about creating new digital assets, but the reality is that financial markets already contain extraordinary amounts of value, government bonds, equities, corporate debt, and the like. The challenge isn't in creating more assets. The challenge is in enabling those assets to participate more effectively in the financial ecosystem. Historically, increasing collateral mobility was often required firms to move those securities physically between custodians or central securities depositories, and that creates operational complexity and cost and settlement risk, and frequently requires institutions to change their long-standing custody relationships. I don't believe that's going to be the future of this. I think that we're separating as we go forward asset safekeeping from asset mobility, not as in separate topics, but not tying them to be inextricably linked together. The asset can remain exactly where it is today, but you can begin to have the ability to participate in financing, collateral, and liquidity activities around the globe on a more immediate and real-time basis by not having to shift the asset around from a safekeeping perspective. The second goal is about improving capital efficiency. Every major financial institution is focused on balance sheet optimization. Capital has become, or is always increasingly valuable, it just gets more and more valuable over time. Liquidity gets more and more valuable over time. And institutions can mobilize more collateral without issuing more. If institutions could mobilize more collateral without using more capital, they could create greater financing capability from exactly the same amount of balance sheet. And so this is where I think tokenization is not fundamentally a technical discussion. It becomes a liquidity and a balance sheet discussion as well. And then the third objective is creating network rather than creating monopoly. If we just simply move to one new system, we're not creating, or if we're enabling someone because they have a technological lock on the market, we're not perpetuating the good form of competitive and capitalistic landscape that has defined financial markets for decades. So there's no reason that digital markets should eliminate the specialization that occurs across FMIs and CSDs and custodians and fintechs. Institutions should remain independent, competition should remain healthy and vibrant, innovation should continue, but interoperability among those organizations is the challenge and is the responsibility of the network provider. That's where we're providing a critical and essential role to enabling those institutions that operate their sovereign products and services to have an interconnected ecosystem where data can move seamlessly across them that provides for that interoperability and preserves the privacy. So those, I say, would be some of the goals of the global financial network. Let's drill a little bit into one of the points that I just made on the cost of inefficient balance sheet use. It was the middle one on the prior slide. And I know all of the goals are equally important, but it's where it actually hits the financial market participants the most. If they can get more efficient balance sheet use, either as a provider of services or as a receiver of services, then I think that's ultimately what starts to fuel the fire of adoption across the industry. Arguably, it's what we're seeing in the U.S. market, as some of us were chatting about before the session even began. So I said, I represent the technology firm or a network firm, but even I would be the first to admit that technology rarely alone changes financial markets. Economics is what changes financial markets. Today, one of the most valuable resources within every bank is balance sheet capacity within every broker-dealer. Yet a surprising amount of that capacity is effectively trapped, not because institution lacks assets, but because regulations rarely require it. Or not because regulations rarely require it, they do all the time, but because today's infrastructure makes collateral difficult to move quickly and confidently, and balance sheet is often what comes in behind that to prop it up. So consider how collateral is managed today. Institutions maintain excess collateral because they can't always be certain that assets will arrive exactly when needed. They pre-position securities overnight because settlement systems operate according to local business hours. They maintain liquidity buffers based on operational uncertainty rather than on economic necessity. They fragment collateral across multiple entities, custodians, jurisdictions, because transferring assets rapidly remains operationally complex. And every one of those decisions is rational. Every institution is managing risk responsibly, but collectively, those practices reduce the productive use of balance sheet for each of those institutions and across the industry. Tokenization doesn't eliminate financial risk, nor frankly should it. Instead, it eliminates the operational friction so that when collateral becomes digitally represented and connected across interoperable applications, delivery versus payment can occur atomically. We saw that in some of Darrell's slides. Institutions can gain confidence that assets will arrive when exactly required. Liquidity becomes available when it's needed rather than pre-funded hours or even days in advance. It can be available on more of a moment's notice. Most importantly, the same asset can potentially support multiple financing transactions throughout the day. It can be used for a couple hours and then a couple of minutes and then not in the normal cycle of a minimum of a day. I believe when you focus on this, the next decade will be, as I said earlier, about optimizing assets. It will be about supporting changes in ownership in real time. It'll be about programming an economic outcome or an economic asset servicing process on an asset. It'll be about supporting repo financing 24/7, about being able to meet margin calls intraday and moments after that call has been made. It'll be about supporting greater securities lending. That productivity isn't just simply the digitization of the asset. It's where the economic transformation of that asset begins. And that is ultimately what I think the is writing the cost of an inefficient balance sheet use by allowing for assets to have greater utility and to be used much, much more efficiently. And that's what tokenization doesn't solve directly in and of itself, but it enables that asset to become a dynamic asset and used more efficiently around the globe. And so what's the impact of that? Just to give you some very specific numbers and talk less in the theoretical and more in what we're actually seeing in the actual market right now.
Sorry,
And
Kelly, you
yes,
have 1 minute.
oh, yes, sorry. Yes, this is the last slide. Although individual estimates vary, industry analysis points are remarkably consistent on this. If you are able to free trapped capacity across a balance sheet, you can gain the utility of that in the order of 30 to 35%. There's many studies out there, but this is what we're seeing as the markets that we're working with are going live. And you gain by having assets gain the ability to be reused more and more in a 24/7 cycle. Ultimately, we're seeing capacity improve by about 30 to 50% across the markets. And all of this then starts to change that scenario of being less about a technological change and more about the economic impact of mobilizing assets and making them more active and more available across markets. And it's starting to have a real balance sheet impact in the order of 30 to 50%. Thank you.
Thank you very much, Kelly. So really, thank you for the fantastic perspectives. And let me quickly summarize among the other things, the four things I learned, and each of them seems to attach a question quickly. Now, the first, I think you talk about there's this demand for the liquidity and collateral outside of the traditional hours. My question here is that does that qualify as a killer app, as Daryl has suggested, or maybe not? I'm not. So that's first question. The
I,
second thing, I think, let me finish this. The
yes, please.
second thing is that you emphasize that they should be actual digital assets. So if they are, and they can be used that way, does that solve the problem Daryl worry about? The trust of the money, stuff like that, if I'm not mistaken. That's the second part. The third is that I talk about the importance of the infrastructure and the features of that. You even talk about the global financial system in the new technology-driven framework. Now, but the world we know is that is so divergent. So do you perceive a global financial network, or you think we're far from that? At what stage we are? Finally, you talk about the balance sheet capacity. You talk about the future is about optimizing the assets. So that seems to be another part of this killer app. But I'm wondering how far we are from that, bettering the pace.
Yeah,
Uh,
I'll give
like,
you a quick answer on each. In terms of the killer app, I really think it depends on which market participant type you are for what will be killer for you. But I really do believe that as important as tokenization is to bring the assets into the financial ecosystem, the killer app is, or killer apps, are those apps in the secondary market that are then doing something with those on-chain assets, on-chain securities or on-chain cash. So I don't know if it's one app so much as it could be DVP purchases and sales for hedging and investing purposes, or it could be repo financing or collateral management. But I do think that it is the use of those assets in the secondary market that is going to sort of light the fire, if you will, on adoption, which is probably my answer to the fourth question. In terms of the second question you have, and onto Daryl's point on having the actual asset on chain. Yes, actually, and Daryl knows this and has actually been a great industry mind that contributed a lot to frame our thinking about this and ultimately led to DTCC as a first example of making a very different approach to this. But it is about having the US Treasury or the US equity on chain. It's not a wrapper, it is not a claim, it is not a derivative. I think that's not an app so much. I wouldn't use the word killer app for that, but I think that's the killer solution. That is the pivotal change in how this technology is being used that I think is going to be adopted by different organizations around the globe, because it is what enables someone to have the same frame of reference to that asset that they have in the TradFi market, but now with the ability to use it in a more a real-time way. On the question of, I forget, what was the third question? The third question was about
Global financial
the
system.
global financial system, sorry. And then the last one was on balance sheet. On the global financial system, I do, to be honest with you, I don't want to put the weight of the world on seeing the DTCC come to market in the October timeframe and argue that the US is driving the way forward. That is not at all what my comment is. But I do think it is the first major financial market to put its assets on chain and make it available for the market participants to use. I do think, given the size and the utility of US denominated US assets, we will see the start of a global financial market, but one market does not make a global financial market, however big it might be. I do think we are starting to see out of Japan, out of Hong Kong, out of the UK, out of the EU, and out of Canada in particular, a very rapid onboarding after the US market. And that I think I will put down here, and hopefully we can check with each other in a year or so. I think that we will see a rather dramatic change over the next year. And the last point I'll make is because that balance sheet impact. I think in the end of the day, it's all a science experiment unless or until it changes liquidity and balance sheet efficiency for organizations that are participating. And we are seeing real numbers as the 30 to 50% recommended that are starting to drive that. And frankly, when it hits your balance sheet and hits it in a positive way, you know then you're going to be doing more of it, and that will drive adoption.
Okay. Finally, a one-sentence question. So, should we measure the progress by the activity of the stable coin or not?
No, I actually think that we should manage the progress by the activity, the transactional activity that occurs in a network, whether that's using on-chain securities or on-chain cash and liquidity, which could be stable coins, tokenized deposits, or money markets. We should be looking for the capital markets to be active on-chain, and that's how we should measure it.